Welcome to Fides Wealth Strategies Group Financial Moment. I have Dr. Chris Rand here.
And Mr. Markello.
And we're here today to talk about tax planning, really around investing, around personal taxes. It's a fun topic. It's a necessary topic. It will put some people to sleep. So,
well, a quick important point we need to say here is Mark or I are not tax advisors.
Yes.
It's important for you to reach out to your own tax professional and consult with your tax professional. What we're trying to do is to talk about taxes in a general context around financial planning.
I feel confident. I did sleep at a Holiday Inn Express last night.
Well, let's go ahead and get into it.
Let's get into it then. We're ready to go. So, some of the basics when you're dealing with tax planning when it comes to investing is it's important to manage the expectation of the asset. When you start talking about, I want to minimize taxes, I want to minimize the way that those taxes go, it's important that they're trained. You're not selling things inappropriately at the wrong times, right? I mean, that's a huge one.
Yeah. So an example might be you have a stock and you're in a higher income tax bracket, and a long-term capital gain would be more tax efficient for you than a short-term capital gain.
Long-term capital gain means you've held it over 12 months in a day.
Year and a day. So you don't sell it a day before the end of the year, unless you absolutely have to, because it's not going to be a good investment any long. But ideally, you would want to hold that asset to a long-term capital gain.
Right.
Maybe buying a stock that pays a qualified dividend if you're in a high tax rate versus one that doesn't. Examples of that.
Some things you don't have control over is if you're in things like a mutual fund. So if you're in a taxable investing account, meaning that it's what I consider to be a non-qualified account, not qualified for tax deferral treatment, in that scenario, you're dealing with, if it's in a mutual fund, you don't have control over when the fund manager himself buys and sells the stock, right?
Yeah. And interestingly enough, in the year 2021, and we've had a few of these years over the last couple decades, where you see a lot of appreciation in the funds, or you see a lot of appreciation in a big market correction. Yeah. And so you see, unfortunately, there's negative fund flows. You could realistically invest some money in a mutual fund, lose money, in other words, the net asset value drops from when you had purchased it, and then you get a capital gains tax distribution at the end of the year you have to pay taxes on.
2008.
And that unfortunately happened in 2021 again with some funds. Which is kind of a weird situation. I'd like to call it an anomaly, but it's not totally uncommon. Mutual funds, what is common is to have these capital gains distributions at the end of the year. What's uncommon sometimes is that the distribution is higher than what your actual gains were on that fund.
Yeah, that's never fun. That's never fun.
So it's just important to pay attention to it, right?
It is,
and know what you're purchasing and getting out of it if you need to before a capital gains distribution if it's not going to work for you.
Yeah, but we never really notified too much when they're going to do that. So
you get a month or month and a half notice.
Exactly.
It just depends on the fund family. Sometimes they're not as quick.
Yeah. Sometimes when we talk about tax planning strategies for self-employed folks, there's options to be able to start up your own 401k. Maybe if you have employees, do you add a 401k for those folks? I mean, that's always a great benefit. I think it's important to keep your employees in mind when doing those type of things. It's a good benefit for them.
I think a lot of business owners and self-employed people don't realize that they have the ability to create a retirement plan for themselves or for their employees, to your point.
Absolutely, it's great. A great topic these days is also converting a IRA to a Roth IRA.
Yeah.
Always a great topic. It's a great way to be able to take money that is in a pre-tax position, meaning that you haven't paid taxes on it, pay the taxes at your current rate, so that way it'll grow deferred, and then if you take it out properly, it'll be tax-free. It's important that those stipulations are there, and that works for some people.
Yeah, there's a big argument about to Roth or not to Roth.
Yeah.
Should I put money in pre-tax investments, get the tax deduction today, let it grow tax deferred, pay taxes later at some undetermined tax rate, or should I pay the taxes today at the determined tax rate, let it grow tax deferred, and then pay no income tax at retirement when I pull it out? And it's really an individual discussion.
It really is.
I think it's safe to say if you're in a really low income tax bracket today, and you're going to be in a higher income tax bracket in the future, you do Roth.
Yeah.
If you're in a really high income tax bracket today and you're going to be in a low income tax bracket in the future, you don't do Roth. It's those people that are in between, which is unfortunately where most people are, that you really got to run the numbers and give some thought as to how you believe tax rates are going to change for you.
Well, and for you, I think that's important you say that, because a lot of times people say, well, I know taxes are going to go up because, we're spending money and this and that. I know taxes are going to go up. But the question I always ask is, well, are your taxes going to go up?
Yeah.
That's important, right? Because your income might be down at retirement.
Yeah. Or you might be a police officer or a firefighter whose pension is going to be, for all intents and purposes, 100% of their income. I'd argue your income's not going to go down. If anything, your income might go up in retirement. Because not only are you going to have the same income you were making before in the form of a pension, but then you're potentially pulling money out of retirement accounts. And so it's not just your income.
You're losing your
and
deductions.
then it's also what Congress may do with the tax rates.
Yeah, you're losing your deductions. Kids are out of the house is paid off. You know, mortgage deductions. You know, all those things. Right?
All those things you got to consider.
Yeah, you have to consider all that. It is not just a cut and dry conversation. I always hear the question is, should I buy the company stock that's being offered to me?
You're talking about like an employer purchase plan, right? Stock plan or something.
I always like them. I always like the idea. It's a good forced on savings. A lot of times those companies will give you a discount.
Yep.
Which is always
How's that work?
The great thing about that, and again, every company's gonna be a little different, but I've heard as great as a 15% discount off the lowest price.
So the company stock is $100.
Yeah.
You get it for $85.
Yeah.
Can sell it at some point in the future for whatever the value is. It's like a baked-in 15% return, right?
Yeah.
In that scenario.
Yeah. In no place can we guarantee that.
Well, that's
for
sure.
Very clear with that.
Yeah.
Very clear with
Now,
that.
the risk, of course, of buying your employer stock, let's hit that real quick, is that you're all in you're all in one company stock.
Yeah.
First, so it could be the best company in the world, or not.
Or it could be
and also something people don't talk about as much is not only are your investments tied to that company, don't forget your income's tied to that company too.
Yeah, exactly.
So if the company starts doing really poor, you run the risk of losing, layoffs, on top of, the company stock price falling. So while there can be some great benefits to investing in employer stock, you always want to be cognizant of the potential downsides. And isn't that true, Mark, with financial planning in general? There's always pros and cons to every single decision I can't think of any decision offhand where it's all positives. Or all negatives.
No.
Right?
If you're being told that this is all positives and no negatives, run.
Yeah. It's possible it could be all positives for you.
Yeah.
But there aren't all positives for everybody. You really got to, kind of weigh it out and see what the pros and cons are.
Absolutely. I think it is. Now, I'm of the personal belief that non-qualified or after-tax investing should be invested and allocated differently than your IRA assets and your 401k assets. So what are your thoughts on that?
Well, so what you're really talking about is ones that have good tax treatment, like long-term capital gains or qualified dividends, or maybe municipal bonds, tax-free interest. So one thought that a lot of financial planners talk about is if you have a Roth account, let's put your high appreciation investments in there, maybe like tech stocks or small cap stocks or international stocks, emerging market stocks. And let's put our blue chip, large cap stocks in our taxable investment account because they're likely to pay qualified dividends. You're probably going to hold on to them for more than a year, typical with a lot of blue chip investing, so you get long-term capital gains tax.
I can't shake that Apple stock,
Yeah. You likely don't want to own municipal bonds in an IRA because there's no tax benefit, a double tax benefit rather. The municipal bond interest is already tax-free. You don't need to hold it in a tax-free vehicle.
Let's talk about municipal bonds for just a second. I mean, a municipal bond is obviously something that is it's a bond, and so it's loanership to, in this situation, a municipality. If it happens to be in the state in which you reside, you can get that dividend from them tax-free from federally, right? And state.
It depends on the state. But,
it depends on the state.
California and New York are common states that there are a lot of state tax-free municipals available.
But if that bond grows in value, it's a different conversation, right?
Yeah, you have some capital gains.
Yeah, you have some capital gains in that scenario. But that is a far better option than just investing in a Walmart bond. Because that does not have the kind of treatment.
You don't have positive tax treatment. But to Mark's point, choosing the assets that you invest in, or choosing the place that you invest those assets, is important. And so you can have that control. You're really talking about tax diversification as well,
absolutely.
Not just how I pay the taxes, but what assets I place
in those each position.
Accounts.
And that's something that we can always talk about with you individually, or however you want to do it. But I do appreciate you checking in with us, and this has been Fides Wealth Strategies Group Financial Moment.